Hi, welcome to my channel. Our topic today is AI-driven investment strategy and portfolio simulation. Most people ask AI random money questions. But here's the real question I want you to think about. What if you could use AI to safely test your investment ideas before risking real money? Could AI help you understand diversification, simulate different life situations, and show you how risk tolerance affects your portfolio? That's exactly what we'll explore today. By the end of this, you'll know how to use AI to simulate a beginner portfolio, a family portfolio, and a freelancer portfolio without spending a single peso or dollar in the market. Trivia to warm up. Did you know the word portfolio originally comes from the Italian portafoglio, meaning a case to carry papers? In finance, it became the metaphor for carrying your collection of investments. So when we say portfolio, we're literally talking about your personal case of financial papers, except now, AI can help you design it digitally. Disclaimer: this video is for educational purposes only. I'm not giving financial, investment tax, or legal advice. AI tools can help you think, but they cannot guarantee profits or predict the future. Always do your own research and consult professionals before making financial decisions. Here's the challenge. Beginners, families, and freelancers often jump into investing without testing strategies. They don't know how different allocations, stocks, bonds, crypto, or cash will behave. That's where AI portfolio simulation comes in. Think of it like a flight simulator for your money. You can crash test ideas safely before flying in real life. Additional knowledge. In the 1950s, economist Harry Markowitz introduced the concept of modern portfolio theory. He showed mathematically that diversification reduces risk without necessarily reducing returns. Today, AI tools can help beginners apply those same principles without needing a math PhD. Let's start with the beginner portfolio. This is perfect for students, young professionals, or anyone just starting out. Imagine you have $25,000 or $500 to invest. You don't want to risk it all, but you also don't want it sitting idle. So here's a simple split: 50% stocks through ETFs, 40% bonds, 10% cash savings. This mix balances growth with safety. Stocks can grow fast but are volatile. Bonds are slower but steadier. Cash is stable but earns little. Together, they protect you from putting all your eggs in one basket. Case study. Investor A puts all 25,000 into one stock. If that company drops, they lose big. Investor B diversifies across ETFs, bonds, and cash. If stocks drop, bonds and cash cushion the fall. Which investor do you think sleeps better at night? Another trivia. The phrase "don't put all your eggs in one basket" dates back to the 1600s. But in finance, it became popular in the 20th century to explain diversification. Pause the video and try this prompt. Simulate a beginner portfolio with 50% stocks, 40% bonds, 10% cash. Look at the AI's output, then resume. Now let's move to family scenario. Families often juggle multiple goals: saving for education, retirement, and emergencies. Suppose a family has $250,000 or $5,000 to invest. They want to save for their child's college in 10 years, while also preparing for retirement in 30 years. AI simulation example. Prompt: simulate a family portfolio with 40% education fund in bonds, 40% retirement fund in stocks, 20% emergency fund in cash. The AI shows allocations and possible growth scenarios. Bonds are safer for education savings because the timeline is shorter. Stocks are riskier but better for retirement because the timeline is longer. Cash ensures liquidity for emergencies. Storytelling. Imagine this family in 10 years. Their education fund is stable because bonds didn't swing wildly. Their retirement fund grew steadily in stocks. Their emergency fund gave them peace of mind during unexpected expenses. Another trivia. Did you know that the first government bonds were issued in Venice in the 12th century to fund wars? Families back then also relied on bonds for stability, proving that bonds have been a trusted tool for centuries. Pause the video and simulate your own family scenario. Adjust percentages based on your priorities. Freelancers face a unique challenge. Irregular income. Some months are great, others are lean. So their portfolio must prioritize stability. Let's say a freelancer earns $50,000 or $1,000 a month, but it fluctuates. They decide to invest $100,000 or $2,000. Here's one way to simulate. 30% emergency fund in cash, 40% growth assets in stocks, 30% stability in bonds. Freelancer A invests everything in stocks. When income drops, they panic because they can't access cash. Freelancer B keeps 30% in cash. When income drops, they use the emergency fund without touching investments. Which freelancer feels more secure? Cash buffer importance. For freelancers, cash is not wasted, it's survival. AI simulations can show how much buffer you need to cover 3 to 6 months of expenses. Trivia. The idea of an emergency fund became popular during the Great Depression in the 1930s, when families realized that having liquid savings was the difference between surviving downturns and losing everything. Pause the video and ask AI. Simulate a freelancer portfolio with 30% cash, 40% stocks, 30% bonds. Compare the results with your own situation. Now let's push AI simulations further with advanced scenarios. Debt repayment simulation. Imagine you have $100,000 in debt and $50,000 to invest. AI can simulate whether paying off debt first or investing part of it makes more sense. Scenario A, pay off debt aggressively then invest later. Scenario B, split funds, 70% debt repayment, 30% investment. Side income portfolio. AI can simulate portfolios focused on dividends, REITs, or bonds that generate regular income. Example, 200,000 portfolio with 50% dividend stocks, 30% REITs, 20% bonds. AI shows potential monthly income streams. Trivia. REITs, or the real estate investment trusts, were first introduced in the US in 1960 to allow everyday investors to access real estate profits without owning property directly. Finally, let's talk about risk and ethics. AI cannot predict the future. It can only simulate based on past data and assumptions. Avoid hype, guaranteed claims, or exaggerated income promises. Responsible investing is about discipline, not shortcuts. Investor A follows hype and invests in whatever AI suggests without checking. They lose money when assumptions fail. Investor B uses AI responsibly, they verify outputs, apply judgment, and consult advisors. Their portfolio grows steadily. Trivia. Did you know that Warren Buffett once said, "The stock market is designed to transfer money from the active to the patient"? AI can help you be patient and disciplined, but only if you use it wisely. Now that we've covered beginner, family, and freelancer portfolios, you can see how AI adapts to different life situations. In the next sections, we'll dive into advanced scenarios, risk and ethics, and interactive workshops to stress test your portfolio against real-world challenges. If you found this video helpful, don't forget to like this video, subscribe to the channel, and hit the notification bell so you won't miss the next part of this series. Comment below. Which portfolio should we simulate next, beginner, aggressive growth, or side income focused? Thank you for watching, bye-bye.